The WTI crude oil market has broken down a bit during the trading session on Wednesday, reaching down towards the $37 level. This is in reaction to the concern of the European Union locking down multiple borders and of course the fact that the US dollar has got quite a bit during the day. Ultimately, this is a market that I think continues to be negative overall because quite frankly the oversupply of crude oil still is a major issue. If we break down below the $36 level, then the market is to go down towards the $35 level and that eventually the $30 level after that. Rallies at this point in time should continue to be selling opportunities. Brent markets also fell, reaching down towards the lows again, but have bounced slightly during the middle of the day. At this point in time, the market is still looking to break down, and I think eventually we will get below the $38.75 level, which would open up the trapdoor to much lower pricing, the first of which being the $37.50 level, followed by the $35 level. Ultimately, this is a market that I think continues to suffer as well, and the Brent market is probably even more sensitive to the European Union than the WTI market is. That being said, this is a market that eventually looks likely to break down, and therefore I look at rallies as selling opportunities, especially if we get closer to the 50-day exponential moving average. The 50-day EMA sits just below the $42.50 level, and therefore I think a lot of traders will be paying attention to it. The fundamentals are bearish. If the freefall continues below $35 level, then we're likely to hear something from OPEC Plus regarding the planned reduction in production output cuts on January 1st. If OPEC Plus starts to feel too much heat, then look for them to postpone the planned reduction. This won't change the main trend to up, but it could trigger a closing price reversal bottom that could lead to a meaningful short covering rally.